Well, welcome, everybody. It's great to be with all of you this morning. And on behalf of the entire Wells Fargo banking team covering the Fresno and the Central Valley markets, I want to welcome everybody to this morning's economic briefing and outlook hosted by Wells Fargo Bank and Wells Fargo Advisors. Today, we're excited to hear from Dr. Michael Swanson, our lead agricultural economist for Wells Fargo Bank, and Gary Schlossberg, our lead wealth and investment global strategist for Wells Fargo Bank and Wells Fargo Advisors. They'll both be introduced here in a couple of minutes and are both here to provide their outlook and view of the economy and many areas of focus of our Central Valley business clients. Basically, jumping to the punchline, though, they've already offered that their predictions of unprecedented growth with no economic disruption and stable prices for the foreseeable future. So if they can promise that, I think we'll all be happy, right? I've met several of you, but my name is Rich Lambert, and I am the market executive for Wells Fargo Bank for the Central Valley of California. And I oversee the commercial banking and real estate operations for the team in the Central Valley. We work with clients that are between $20 million in annual sales, upwards of $3 billion in annual sales, mostly focused again on commercial business and real estate investors. Thrilled to be here with you today and looking forward to get to know those of you I haven't met when we have the opportunity. By way of background, I actually have been with the bank for about 30 years. I've been in commercial banking for about 28 years, so it's been a long time. Recently relocated here from Salt Lake City, Utah, where I held a similar role. Excited to be here. It's been really fun to get to know the businesses in this market. Very unique and amazing market, very dynamic, and I think it's something that's been a great move for me personally and also for to be part of this great team. Today, we're really honored to have a broad representation of businesses across the spectrum. We have business leaders from across various industries here in the Fresno market, and we want to thank each of you for the role that you and your businesses play in building our community through job and economic development. We're fortunate to have each of you in our state, and we're really, truly better because of it. We're also excited to provide a venue that you can get together and network and maybe meet some new folks today. Lastly, I'd like to provide a little bit of information about the depth of Wells Fargo and the involvement we have with the Central Valley market that many of you might find interesting. In case there's any question about Wells Fargo's commitment to the market, I think there's some interesting facts here. Wells Fargo currently has about over $6 billion of loans and lent into a variety of businesses across the Central Valley. This is between our agricultural team and our commercial banking team. To give you some perspective, that's actually larger than the markets covering both Nevada, Utah, Colorado, and Arizona, just in the Central Valley. We have 25 bankers covering this market, and that's then dozens of support team members that are here, which is the largest market of any of those large banks, including the largest market share of any of the banks we have here in the market. Our bankers live in the communities that we serve and are heavily involved in finding ways to help our communities grow. So before we go too far, I do want to thank a few people here. We've got our fearless admins, Sherry and Avonlea, for putting this together, so thank you for taking the time. Brent Hobbs, the Business Development Officer, Scott Iverson, who's here with me today. Our wealth investment team is also here too, and if you get a chance, we'd encourage you to meet them. We also have a number of folks here that I'm sure I won't be able to mention. Brian Ekmanian for providing this venue, and we're fortunate to have this. But today, I'd also like to turn the time over to Scott Iverson. Scott is he's the market executive and my counterpart for our Wells Fargo agricultural team. So, as one of the top agricultural lenders in the world and the largest agricultural lender in the U.S., Scott and his team work with growers and processors across the market to provide capital and help clients meet their financial goals. Scott and his team are great partners with our team, and we work closely with them to meet the needs of our dynamic Central Valley clients. So I'm going to turn the time over to Scott. He'll introduce our speakers and also provide an outline for the rest of the meeting. So thank you.
Got to keep it close. Thanks so much, Rich. I said this yesterday in Bakersfield. If you guys haven't had a chance to meet Rich is a fantastic addition to the California management team. Coming from Utah and all his experience in commercial lending, he brings the right personality, the right perspective, the right understanding of our markets and what we do. So thank you, Rich, for all you do. Welcome to California. Yeah. So with that, my name is Scott Iverson. I run the agribusiness team. Our team is a national practice, but we cover Bakersfield basically up through Canada, out here the Central Valley. As Rich said, we're deep in loan commitments. We have about 200 customers in the agribusiness space, and that's producers, processors, vertically integrated food companies, input providers, and that's about $3.5 billion in capital. So it's extremely large debt investment that we have in this space, and we're comfortable doing that given the broad team and resources that we have. Full credit underwriting within the ag sector, full loan supervision. And I mean, most importantly, we have an institute in Wells Fargo called the Wells Fargo Food and Agribusiness Institute. Within that institute, they're not bankers, they're industry experts. So when you're in agribusiness, it sounds like a specialty group when you're talking to a large bank. Inside agribusiness, there's like 14, 15 different subsectors that we focus on. Whether it's proteins, whether it's row crops, permanent crops, dairy, whatever. We've got someone that's focusing on those spaces, looking at a national perspective. Because what's happening every day in the Central Valley is really important. And us, boots on the ground, we can see that. We follow the weather, we follow the water, follow commodity prices. But this team really steps back and looks at the geopolitical concerns, the distribution channels, what's going on in shipping, what's going on with foreign exchange, you know, all the different things that affect the businesses that we're all in the Central Valley, but might not be happening here on the ground. So, you know, at the top of that group is our economist, Dr. Michael Swanson, chief economist for Wells Fargo. Many of you have seen him here or in other venues. You also see him quoted in the Wall Street Journal. He's on the news, doing lots of different reports. So, with no further ado, I'd like to welcome Dr. Swanson to the stage, and let's get started.
Oh, thank you, Scott.
Thank you.
All right. Well, it's a pleasure to be covering a lot of territory this week. So we were in Bakersfield yesterday. We're here in Fresno today. Tomorrow, I'll be in Huron, South Dakota. Yeah, all right. Who's ever been to Huron, South Dakota? Yeah. No, don't go there. But it's going to be fun, you know, and I was sharing with the Bakersfield people. It's one of my favorite locations to present because actually later in that day, I'll go from Huron out to Watertown, South Dakota, and be at the Winter Fair in Watertown. And I'll be in the cattle ring. They actually have me present down in the cattle ring. So before I present, there's going to be the Charlet being auctioned off. And after I present, there's going to be the Herefords auctioned off, okay? But last time I was there, it was interesting. They got down in the ring and they put down a whole bunch of new wood shavings for me to stand on, which is kind of nice, right? And so I said, well, thanks, guys, for putting down the wood shavings. They said, oh, no problem. We know what economists leave behind. Come on. Yeah, you're working on that one. Yeah, it's early in the morning. Have another cup of coffee. But you know what? There's a lot of economist jokes out there. Gary and I were talking about economist jokes yesterday, right? And the problem with economist jokes is we don't think they're funny and you don't think they're jokes. So, well, let's talk about some of the things around food and economics. And then Gary's going to kind of broaden that discussion to some of the other elements of the economy as we go forward. So it's a great tag team. It's always great to tag team with somebody else. But, you know, let's start with some things. So we went through a situation that's been unusual for the American consumer. Starting with COVID to today, we went through two huge waves of food inflation. I mean, in the middle of 2022, food inflation at home in the retail sector hit 14%. We had literally two generations of American consumers who had never seen food inflation at that rate. And it really disrupted their thinking about how much does it cost to buy food. Now, that's behind us. And I want to share something about that disruption. It was never about a lack of ingredients. The United States is blessed with a superabundance, which is a problem for producers, a superabundance of commodities. We need to take a lot of our commodities out to that global market, and that wasn't the problem. The problem was the transformation of commodity food into consumer food, the packaging, the labor, things like that. So that disruption, packaging, labor, transportation, allowed food inflation to erupt. It hadn't been seen there before. Now that was quote unquote good for retailers. It was good for food manufacturers to be able to finally move their prices in a big way from where they've been stuck for years. That's behind us. So if we're in the food environment, flat food pricing going forward in 2024, maybe even slightly negative, is going to be tough on the producer and the retailer and the manufacturer. It's going to be great for the consumer. The consumer is going to kind of get to that point where they kind of have a new price point in their mind, and they're going to be happy about that. Now, another point I'm going to talk on briefly is biofuels. It's not something that California usually thinks about, but what California has done is they've really kind of promoted renewable biodiesel. And that renewable biodiesel is kind of shaking up the market. Not so much here in California, that's a demand function. But across the Midwest, we're seeing the question, well, what do we want to grow soybeans for? Are we growing them to export them to China? Are we growing them to crush them to feed animals? Or are we growing them to crush them to gouge California motorists? The answer is gouge California motorists. But if you were guessing about that one, that's the answer. So it's a question about what that's going to do. We'll talk a little about that. And just also, before we get going too much, things are different today. And Gary you probably note some of this as well. The China of today is not the China of 5 years ago, which is not the China of 20 years ago. It's not a growth model anymore in China for the most part. Now, it's a huge market. And the delta, whenever they make a change in China, it still matters to everybody in the food industry. You know, are they going to buy almonds this year? Are they going to be long or short a commodity? Makes a big difference. But they're not a growth market anymore. Another competitor that you probably don't watch too much, but we do, Brazil. Brazil is kind of the next place to go to get whatever you need in the world, whether it is grain and oil seeds or it's chicken and just about everything else. An interesting connection. It's not Brazil, but it's their little cousin just to the south, Argentina. I mean, there's not many lemons up in this market, is there? No. But if you go further south, towards Oxnard, that area, growing those lemons, they're in a tough spot because if the price of lemons goes up, guess who puts in another 100,000 acres of lemon growing? Argentina, right? So there's this dynamic out there between Brazil and Argentina about when we want better prices, can we get them? Or is there somebody down there who's going to step between us and that price point? And that's something we want to talk about a little bit. And then Russia. Russia's kind of a weird thing. You don't think about Russia too often. They're always in the news about geopolitical risk. But we forget that Russia has immense amounts of agricultural growth potential. And they're very disruptive in a lot of markets. One of the markets we're seeing them right now, which is really surprising for a lot of people, is the chicken market. They're out there stepping between us and any new growth in the world for chicken. So just some things to think about. So let's start out with money. Anybody in this room because they're concerned about their money? Oh, come on, right? Let's be honest, right? You're not doing this just for your health. You're doing this to make some money to support your family, to grow your wealth. And one of the things I've been looking at very carefully, because we have the data. You have to start with, do you have some data to talk about? The numbers matter. So one of the numbers that matters to people is ROA, return on assets, right? If you have $1 million of assets in a business, what should you expect as a return? Now, there's really 3 R's that we all talk about all the time, right? ROA, return on assets. ROE, return on equity. That's your portion of the money that belongs to the business. And the rest is probably borrowed from Wells Fargo, but we thank you for that. And then there's ROI, which is new investments. What if I put another $1 million into my business? What do I expect to get back from that? But this is kind of ROA. This is the big bucket. It's all your assets versus your returns. And the point I want to make up here with this chart is that everything's connected, even if we can't see how. Like I'm going to be in South Dakota tomorrow. Corn and soybeans is how their world works. Here in this market, it's going to be pistachios, almonds, table grapes, wine grapes. It's going to be fruits and vegetables if you go to Salinas and Watsonville. Everybody has their crop. But you know what? Everybody deals with the same dynamics. So if you start on the right-hand side of this chart, you look at where the money enters into the world of the farm economy, either food retailing or food service. And what you'll notice there is they have the highest ROAs, the highest returns. You give them $10 million and they're going to get more money than anybody else in this connections. Why? Because they have the ability to do the most differentiation as far as the consumer is concerned. Look at food services, highest, 12% ROA over the last 13 years. Is Chick-fil-A the same as McDonald's to the consumer? Help me out here. Give me an honest answer. Hell no. No? When you pull up to Chick-fil-A and you see their triple track racetrack around the store full, and they're banging out orders, like crazy, versus you pull up to McDonald's and they're like barely getting that one lane to pass along, it's not the same. So the consumer can be differentiated, and so they can at the retail. Whole Foods versus Aldi's, they're not the same thing to people. But as you work your way back through food manufacturing, livestock farming, energy, land, all those things, they all have a number. And there's a reason why. And it's important to understand that, do you want to be here or do you want to be there? And can you move? Those are the kind of conversations we like to have one-on-one. And so here's an offer. If you want to know more about the numbers behind these numbers, let's have a conversation. Let's put together a Teams meeting call between yourselves and us, and we'll talk about those numbers. But let's talk a little bit about what's behind the average. You know, one of my jokes is, Fargo, North Dakota. Anybody ever been to Fargo, North Dakota? Okay, good, right? One person's been to Fargo, North Dakota. And I'll tell you this, the average annual temperature in Fargo, North Dakota is 42 degrees, okay? But if you dress for 42 degrees when you're in Fargo, you'll be miserable for 9 months and dead for 3, okay? So there's average out there, but it doesn't mean that much. So let's talk a little bit about averages in these subsectors. Here's food manufacturing. We have over 1,000 participants in this database each year. And we can stack rank them from worst to best. So we take the 25th from the bottom percentile, the median, which represents the average, and then the 75th, which represents the high end. A couple of things you want to look at here. First off, look at the spread between poor, average, and strong. There's an incredible gap in returns on their money. The people on the bottom have like a 1 to 2% ROA, okay? But look at the people on the top. On average, they're closer to 15%. What do you think that represents for the industry? Churn. Because the people on the blue line want to eat the people on the green line. And that's just the way it's going to be. Now, the other thing you see is they cycle together, up and down, up and down. But are they trending? That's another thing you want to see. When you ever see a time series chart, there's 3 things you can see about it. Tracking it over time. Is there a trend? Are there cycles? And are there events that we can recognize? And COVID was kind of an event. It took something that was depressed and pushed it up, but now it's starting to come back down to where it was before. So we see some of these cycles around these big events that we have in there. So this food manufacturing. How about food services or restaurants? Once again, huge gap between the bottom and the top. I mean, the top is absolutely wants to grow, absolutely wants to put another 10, 100 million, billion dollars into this industry with the returns they're getting. The green line doesn't know they're going out of business, but they are. And so it's interesting to see. And COVID was an incredible event for the food service industry. 2020 shut them down. 2021 came roaring back. A lot of financial help from the government. And then they struggled in 2022 with higher food prices that they couldn't pass along fast enough. When we get back to 2023 data sometime later this year, what we'll see is that they kind of recovered as they had higher food inflation at the restaurants above their food ingredients. We'll talk about that a little bit more. But here's the point, and here's the invitation. We have the numbers. We have the numbers for your business sector or something that's very related to it. Give us a call. Let's talk about that. Let's see what's happening around these numbers. So let's talk about the consumer, and Gary's going to do a good job talk more about the broader market, but I want to talk about some things that impacts consumption and then agriculture. Last year, I was a very lonely economist, not a strange thing, but I predicted no recession in 2023. Why? That's because they don't happen very often. Later on in a couple slides, I'm going to show you, we've had 3 recessions in 33 years, okay? That's not a lot of recessions, and we label them. We give them names. They're kind of like hurricanes. And we'll talk about those recessions and talk about how they're the same and how they're different. But just think about this. Don't predict recessions. Now, another thing, and Gary's going to make a good point about this, is low growth can appear to be a recession for a lot of people, right? All economics are personal. When my neighbor's unemployed, it's a recession. When I'm unemployed, it's a depression, right? That's the old saying. So all economics are personal. So if we're in 2024 and we don't technically have a recession, but we have weak enough growth that your sector, your business don't perform well, you're going to say, he was full of it. This is like a depression to me. Okay, I understand that. But we're not really seeing it. Even if there is a recession, it doesn't do anything to the food sector. I'm going to show you very clearly. 3 recessions in the last 33 years, and not once did the American consumer spend less money on food. Just doesn't matter. One of the things that we know inherently, and I can tell you the statistic, if you take personal income versus food spending in the United States, it's only about 7% of personal income going to food spending. And once again, that's 42 degrees in Fargo. For a person on a lower income, it's a lot bigger piece of their spending. For wealthier Americans, it's almost nothing on their personal income spending. But 7% is the lowest percentage of any country in the world. So why would consumers save money in a recession by spending less on food? They simply don't. And they don't even stop going out to eat either. They go to different restaurants perhaps, but they don't stop going out to eat either. So we're going to see that. And there's some commodities. The thing I mentioned earlier, China, Brazil, Russia. We can't grow something that we have to export and then not understand that the global market is going to be the pace setter. So let's talk about GDP, gross domestic product. Anybody remember GDP from their economics class? Economics 101, right? Taught on a Monday morning by a boring professor? Yes, that's the officially sanctioned method for teaching economics, right? So it goes in one ear, comes out the other. But let's do a little primer on GDP. What is it? It's the goods and services the U.S. economy produces in the course of a year, okay? What are the 4 big buckets that we put our spending into? First one is the biggest one, 70+% of the economy is in personal consumption. That's your Visa statement when you get it each month, right? That is personal consumption. So when you think about it, 70+% of the U.S. economy is personal consumption. And what's changed over the last couple of decades? More and more of it is services. More and more of it's services. That changes the economy. Number 2 is going to be government spending. Now, government spending is kind of a unique animal because you have to take out transfer payments. When you see Social Security and Medicaid and Medicare, those are not government spending. You're thinking, whoa, how can that not be government spending? Because it's a transfer payment. Government takes it out of your pocket, and I know they take it out of your pocket because you're in this room this morning, and they put it in somebody else's pocket, okay? They spend the money. It doesn't count as government spending. Government spending is roads, defense spending, buildings, things like that, education. So then you also have net business investment, which is a pretty volatile component over time. Feel good, don't feel good, but it's predictable. And the last one's net trade. So those are the 4 big buckets. So let's look at GDP. 2 ways to measure it. Nominal GDP, not taking inflation into consideration, and then real GDP, which is adjusted for inflation. Which one do we live in? Which one does your Visa statement come in? I've called up Visa and told them I want the inflation-adjusted Visa statement. They did not allow me to pay my inflation-adjusted Visa statement, right? We live in the top line here. $28 trillion of economic activity on an annualized basis at the end of the 4th quarter of 2023. That's a huge number. So let's be very, very careful. What did I hear on the news this morning on Good Morning America as I was sitting there in the hotel lobby eating my Wheaties and drinking my cup of coffee? Consumer debt's at an all-time record. Were they referring to inflation-adjusted consumer debt? No, they were referring to consumer debt. It has to be compared to the top line. The bottom line is a make-believe land where economists live. We're very strange people, right? But it's a legitimate question to ask, are we better off adjusted for inflation? And the answer is, yes, we are. Now, it's not as robust and amazing as the top line, but still growing. But let's dig down a little bit. So, when there's a recession, we typically notice some things. There's a group called the National Bureau of Economic Research, and they call recessions. They're like the NFL, referees. They throw the flag and say, you're in a recession. And let's see, how much cord do I have here? I got enough. I can come over here. There was a point in 2022 where we saw personal income adjusted for inflation go down for about 8 months. And suddenly people were saying, hey, we must be in a recession at this point if personal income is going down. But we didn't see personal spending adjusted for inflation go down either. Now, we know what happened in 2020, 2021, and 2022. There were incredible amounts of transfer payments and special government aid coming into the economy at that point. That's not in this chart. This is just personal earnings from either working or investments. So we didn't call a recession, even though we had declining personal income. That's because you need more to happen than that to call a recession. But we saw personal income bottom out, and then recover quite nicely. We're once again at the highest point we've ever been at in terms of real personal income, adjusted for inflation. And we're seeing that personal spending parallel that growth as well. Now, what's probably more important to the average American, and that's an interesting term, the average American, who's not average. But the most important thing to most Americans is, do I have a job and can I get one if I need one, right? That's important to them, because what's the best way to pay your bills? Get a job, right? And you can see COVID, we shut down the economy and then started to back up. And we have not had really a month where we haven't seen job growth since that point. We got the last jobs report out in January. It's not in this report here. We got 335,000 new jobs. We were expecting about 110,000, something in that range. Wow, okay. So the economy is still producing a lot of new jobs. So for the average American, their answer is, yeah, we're not in a recession. I can find a job. I have a job. So there's a lot going on around the job sector. And can you find a job? This is the ratio of job openings to unemployed people. And what you can see is, you go back pre-COVID, we had about, let's say, 4 to 5 job openings per person that were unemployed in the market, which was historically really, really strong. And then where are we today? Even after we started to normalize the economy, slow down the payroll growth, we're still above 5 jobs per person unemployed in the economy. So there's a lot of jobs out there. That's the point of this graph, is there's a lot of job openings out there when you start looking at payroll and who could take them. How about industrial production? Industrial production is this index we put together. It says factories, power plants, all those things that are considered industrial. We're actually still above where we were pre-COVID at this point. So when you look at this chart and you look back over the last couple of years, it has not slowed down. The economy has been remarkably robust. Now, it's fair to talk about things that could go wrong, and Gary does a good job of laying out the pros and the cons, and I'll leave that to him. But so far, we have not seen those cons overwhelm the pros. But what about interest rates? Anybody interested in interest rates? Any interest there? Oh, come on. I know you're not vegans. You can raise your hand, right? You got enough strength to get them over your shoulder? Oh, come on. They'll love that joke in South Dakota. But the Federal Reserve tries to do 2 things. I've always told people the Federal Reserve has a tough job because they have dual mandates. There's no other central bank in the world that has a dual mandate. They're supposed to make sure we have price stability and maximize economic activity for employment. Now, those 2 things don't always work well together. So the Fed dropped interest rates around COVID and then raised them very rapidly and has plateaued. Now, the market's had a little bit of a fit recently because the strong jobs report, the stronger GDP number, some of the stronger numbers we're seeing is telling them, hey, you're not going to get a price cut in interest in March like you were hoping. Now, it's interesting. You say the market forecasts. Sometimes the market wish casts. They put a wish out there and pretend it's going to happen, okay? But the question is, how long will this be flat? Because almost everybody agrees the next direction is down. But the question is, when will it be down and how far will it be down? And luckily, we do have Gary to talk about that just a few moments, right? I'm just teeing off all the good questions for you here, Gary.
Thanks a lot.
Yeah, he's making notes about never present after Mike again. But there's other things happening in the economy. One of the things the Fed started to do during the banking crisis of 2008, 2009 is quantitative easing and quantitative tightening. Those are new terms, things that we haven't talked about before. And what quantitative easing and tightening was about is like the Fed's really good. This chart here, the Fed funds rate, affects the short end of the curve. When you borrow for today, for the next week, this is Fed funds. But what about when you're borrowing for 10 years, when you're buying a new house, when you're buying commercial real estate? That's being driven by the alternative value of treasuries, 10-year treasuries. So what the Fed did in order to depress the interest rate on treasuries, which would depress the borrowing cost for mortgage-backed securities and other things, is they bought a lot of them. Because when you buy a lot of bonds, you're out there bidding up the price, which depresses the yield, the interest rate. Now, the Fed did an extraordinary amount of injection of liquidity. They went from right around $2 trillion of treasuries, almost to $6 trillion in treasuries in less than about a year and a half. But since that peak, they've run off almost $1 trillion plus of treasuries. And they're trying to figure out what's the right rate of adjusting their balance sheet. And they've made some announcements about changes. I'm not quite sure what they mean. They're going to let us know as they go forward. But this is something that really affects a lot of things. It affects money supply. It injects money into the system. It affects the rate on longer-term assets, which affects the alternative cost of borrowing for buildings and other things. A lot of things are tied to this kind of new dynamic. But let's talk about inflation, because the Fed's concerned about inflation. What's the biggest driver of inflation? What's the biggest cost for most businesses on their P&L? It's going to be labor. Now, the Fed is shooting for a 2% inflation rate. That's kind of their golden number that's out there. But let's look at the year-over-year change in wages. This is average hourly earnings, all employees. We just finished up 2023. We had a 4.5% increase in the average wage rate. Go back pre-COVID, we were running between 2 and 3%. Do you think the Fed's happy with this right now? You think the Fed says, oh, we can run at 4.5% on wage growth for the foreseeable future and not have more inflation in the system? I don't think so. The Fed needs to see this move back down significantly. But how does this move down? It moves down over millions and millions of conversations between an employer and the employee. Hey, last year was last year, this year is this year, this is the wage I'm willing to give you. We've seen a lot of union negotiations talking about big wage increases. If the Fed wants to have inflation down around 2%, this can't keep happening. And so if it can't keep happening, it's not going to happen. Now, will it be an easy adjustment? No. What do all employees want? They want higher wage growth than inflation growth. What do businesses want? They want to make sure that they can keep their profitability in line. Now let's dig down a little further. And this is an ugly chart. Show of hands, who agrees this is an ugly chart? Lots of things going on here, right? But let's go back and remember what we can look at. We can look at trends, we can look at cycles, and we can look at events. Now, PCE, personal consumption expenditure, is kind of the cousin of CPI, Consumer Price Index. This is what the Fed talks about. But I want to make this point. And this is a chart that I didn't even show down in Bakersfield. It's not in your deck. We can send it out later. But let's look at the big buckets here. Durable goods, non-durable goods, and services. Very different animals. China. China has been a depression on durable good manufacturing prices for decades. They became the world's manufacturer all over. We've become used to durable goods being a negative inflation factor for a long time. You go back 2013 all the way to COVID, and we had negative durable goods inflation as a running basis. We had that supply shock, shut down China, shut down the supply chain, spiked up, but look where we're back. We're back down to negative durable goods pricing. Now, non-durable goods, clothing, food, things that you're supposed to last for a year or less, it's not predictable. It has cycles down. 2014, 2015, that's about food, up, down. A lot of that's around food. We had a huge spike in that non-durable goods because of the food inflation we talked about. But it's starting to collapse back down towards zero. What's the one thing that never really slows down in terms of inflation? Services. Even during the low inflation environment, we had 2+% on services inflation. It was muted because of the durable goods and the non-durable goods being zero or negative, kind of in the mix there. But we're still at 3.9% on that services inflation. What's the other thing you notice about services inflation if you look at that line? It doesn't move quickly. When you look at non-durable manufacturing goods, things that are like food, they rocket up and they come crashing back down. Services is slow to change. So the Federal Reserve is looking at a lot of things underneath the surface on an ongoing basis. So let's talk recessions. I said I was going to name them. So who remembers the tech stock bubble recession? Anybody remember that? Okay, yeah. That was 2000, 2001. So what we have on this chart is the green line is that nominal GDP growth year over year. The red bar is the real GDP growth year over year. Look at 2001. It didn't go negative. We had a recession, had about 1.5% decline in payroll, but we didn't actually go negative for the year in GDP. So that's our first recession. Then we had the housing banking crisis recession of 2008, 2009. Who remembers that one? Oh yeah, okay. If you're a banker, you better remember that, because if you weren't alive then, that's crazy. Because when you think that was 6 quarters, that's a year and a half, we had a 5.5% contraction in payroll. It's a massive recession. You can see that recession. In 2008, we had flat growth. In 2009, we had negative growth. That's a real recession. And then we look at 2020, the great toilet paper scare of 2020. Remember that one? That was a 3-month recession, okay? I have cottage cheese in my refrigerator that's older than 3 months, right? It's a crazy thing, but we've had 3 recessions in, 33 years. They don't happen very often, and they're all unique for unique reasons. So predicting recessions is really kind of a far out thing to do, because there's a lot of things that are going on underneath the surface. The point I made earlier, I want to stick to that. The black line here is food spending, personal consumption expenditure on food. And here are the 3 recessions we just talked about. Tech stock, Great Recession, COVID recession. In none of those 3 recessions did we see personal consumption expenditure on food decline. So food is not where people save money. If we have a recession, who gets hammered? It's going to be RV sales, right? In Goshen, Indiana, where they manufacture RVs, they're in recession, they're in depression right now, because everybody bought an RV during COVID and they're not buying a new one right now. And even if we look at that, we can look at those 3 recessions. Here's food away from home, the blue line. The orange line is food and beverage store spending, food at home. Look at that. We see COVID, which was very unique, but look at the rocket ride in spending on that. In none of those recessions did we actually see restaurant spending go down, except for COVID when we shut down the restaurants. So if you're in the food business, if you produce the commodities, the almonds, the pistachios, the table grapes, it's not about the economy. It's about everything else in your world. Let's talk food inflation before I finish up here and hand it off to Gary. Look at this chart. The American consumer was shocked by this chart. They really were. Pre-COVID, 0 to 1% food inflation at the supermarket. We had higher inflation away from home because there's just more labor involved. And we see the first spike up in food inflation, and then that massive spike, July of 2022, 14% year over year. The consumer is still adjusting to it. But if you're going to look forward, this is going to go back down to where it was before. It's kind of going to be zero-ish at that retail level. Great for the consumer, tough on us in the food supply business. But look at the gap between food services away from home and at home. The consumer is going to start to notice this. The longer you have 5+% restaurant inflation versus 0 inflation at the supermarket, it's going to be tough on the restaurant segment to maintain that gap, because the value is going to get eroded pretty quickly. And let's talk a little bit about California in particular. Fruits and vegetable inflation. Now, it's incredible when you look at this chart back over 10 plus years. If you actually put a trend line in this data, it doesn't really trend. Fruits and vegetables are flat across this last 12 years. You had an incredible spike, but it's come collapsing back down. Why is that? It's because we have Mexico. If you go to Nogales right now, what's coming across the border from Mexico? Fresh fruits and vegetables, right? There's a huge supply. Chile, Peru, Mexico, all around the world, we've extended our reach for fresh fruits and vegetables. Helps the consumer, year-round supply, but it is competition to the California market that's really hard to overcome. And I'm going to finish with this last point. Is food really expensive? I'm going to use an example. The consumer thinks it is. Let's look at meat prices. It's something that everybody buys. Look at the shocking run, like on beef prices. $8 a pound, average retail price last year. You go back just maybe 5 years, it would have been $6. That's a significant change. You look at the pork pricing, you look at the broiler pricing, those are huge, huge run-ups as far as the consumer is concerned. They just absolutely are blown away by this. But what doesn't the consumer also appreciate? Think about that wage inflation we saw a few slides back. That's just natural to them. They just get more pay. They think, yeah, that's the way it should be. So if I take these numbers and say, what did you earn? How much could you buy? If you worked an hour, how much could you buy? This is what we get. So going all the way back, I can say, what did they earn and what was the price? This is how much they could buy if they worked an hour. Going all the way back to the 1970s. Let's take beef. Beef is really expensive right now. In 2023, you could buy 3.6 pounds of beef if you worked an hour on average. In 1980, it was 2.9 pounds. We had a huge herd back in 1980 versus today. But guess what? Beef is even more affordable if you have income. Pork is more affordable. Chicken is way more affordable. So the point that I want to make is never let them tell you that the consumer cannot afford food. That is not the reason why you're seeing soft demand. Soft demand is because something's wrong with pricing between here and there. So with that, let me stop. Any questions before I hand the mic over to Gary? Thoughts, questions, complaints, comments are all legitimate. Yes? That's because Gary's going to talk about stuff like that. And secondly, the national debt is a really strange animal. I'll throw a few points out there and then let Gary do a better job of cleanup. One is it's nominal, so we have to compare it to that $28 trillion GDP. Secondly, we saw that the Federal Reserve holds about $7 trillion of that national debt. And I've always asked myself, what does it mean to owe yourself money? Because we, quote unquote, own the Federal Reserve. So when we pay the Federal Reserve the interest that they require on the Treasury debt, what do they do with it? Well, they actually turn around and refund it back to the Treasury. So the Treasury pays them, and then they pay the Treasury. So it's really a strange animal. Now, I'm going to tell you right up front, we have too much debt as a country. We really do. Because we can't bring ourselves to either cut spending or raise taxes politically. And that's not sustainable over a long period of time. But it's a very strange animal as well. Treasury debt's a very strange animal. But it's a good question. I'm in your camp. We have too much of it.
You pointed out real wage growth of around 4.5%. That was going to be a challenge for the Fed to bring that down to something in line with the inflation target. Is it possible? The challenge that I see with that is it possible to have real wage growth and meet the inflation target and the Fed comfortable with the level of inflation?
You know, it is possible. It takes time to transition to it. So, you know, it's easy for me to stand up here and say this is going to happen. I don't say when it's going to happen. But what we're going to see is the effective wage has to improve. You as the employer you have to be able to get more product developed or more services delivered for the dollar that you're paying your employee. The real challenge is, can you find the best combination between the technology, the labor, and the price point that you need to sell it at? That's the real challenge. A good example would be, you know, European wages are very, very high on a nominal basis, but when you look at the effective wage, they're pretty reasonable. My son-in-law works for a company. They moved all their production from Germany to Romania because Romania was really, really cheap. It was really, really cheap for a reason. You couldn't get the workers to produce anything. So paying them anything and getting nothing out of the system was very, very expensive. So they moved almost all their manufacturing back to Germany because they paid them a lot of money, but they got a lot of product out of the system. And I think that's just a real basic example of how can this work, is that we'll have to see better labor improvement through better capital deployment and better technology for the Fed to get that to work out. Gary, I'm going to hand it off to you since you look like you're eager to add a lot to this conversation. Thank you very much.
Thank you, Mike. Thank you, Mike. Pleasure to be here. It's been a while since I've been to Fresno. I've been with the bank longer than I care to admit, but as I said, it's been a while. It's great to be back. A couple of housekeeping chores. First of all, I have no visuals. Unlike Mike, I work in a part of the bank that's a little more heavily regulated, and I found that over the years, just really difficult to put together charts in a timely way. They have to go through our compliance people, risk management, and the like. Brave new world of regulation. So I'll use that as cover. The real reason is I don't want to leave a paper trail. I can't tell you how many times I've been wrong more than right. So it's a convenient excuse, but there it is. Secondly, in Bakersfield, I said I do have an economist joke. I won't tell it beforehand. If you really want to hear it, I'll tell it afterward. Someone asked me to tell the joke afterward. It laid an egg. So I'm not going to even tell the joke this time around. Just let it go. What I will do is give you some of our thoughts on the economic outlook. It's really a starting point for what I was asked to really comment on. The risks in the outlook, certainly, but the heart of it, what our investment strategy is, given the economic outlook that we're looking at. And it's not really too different from what Mike had mentioned. Recessions are a rare breed. Suffice it to say, we were among the groups that did anticipate a recession about a year and a half ago. I mean, all the stars seem to be aligned. Some of you may recall inflation was soaring. We talk about real wages, that is, wages adjusted for inflation. What many of us talk about, speak to as purchasing power. That was underwater for a time during the worst of COVID. Interest rates were rising. The Federal Reserve was very aggressive in raising rates. It was late to the party, late to recognize that inflation was taking off and would stay high a good deal longer than they anticipated. And so there was a certain amount of catch-up there. And supply chains were disrupted. It just looked like all the stars were aligned for a recession, and we made that call. In the event, the economy moved through. In fact, 2023 was a very good year for the economy as a whole. We had a growth of over 3%. Our long-term norm is more like 2.5%. An indication of the kind of strength and resilience by the economy over the course of the year. Looking into 2024, we had continued to forecast a recession until recently. At this point, we think that the forces are aligning so that what we're seeing is a flattening out in the economic cycle. We do see things beginning to weaken over the next several months, followed by a very modest recovery thereafter. The real key to this is COVID. We put the worst of it behind us, but at the moment, we're in what we call a period of post-COVID or post-pandemic strengths. What are they? Well, there's still catch-up in the job market. Employers are still trying to bring payrolls back up to a more normal level. They are in some industries, some notably healthcare, still way behind, and we're seeing good strength there. Employment generates income. Income provides the support for consumer spending, which Mike mentioned is the main part of the economy. It's about 70% of total spending. More important than that, if you look at the economic cycles going back over the past 50, 60 years or so, you'll see that inflation tends to peak around the time that the economy peaks. I should say the economy peaks around the time inflation peaks. Rising inflation squeezes the life out of economic growth. It squeezes purchasing power, squeezes profit margins, forces the Federal Reserve to raise interest rates, which in turn squeeze housing and any other sector. Big ticket spending by consumers, investment spending, squeezes that spending by raising the cost of borrowing. In this cycle, this was unique. Each cycle has its own footprint. This one obviously with the distortions created by COVID. And in this cycle, we saw supply chain disruptions, people being laid off or just moving to the sidelines out of fear of COVID, shortages being created, inflation spiking, but peaking way back in the middle of 2022. As supply chains, as the job market slowly began to readjust, we had inflation coming down. And it's been coming down since the middle of 2022. What effect has that had? Well, first of all, it's freed up income, boosted purchasing power. Inflation began to move below wage increases, kind of thing that Mike was talking about. Purchasing power provides the support for consumer spending, whether it's big ticket consumer durables like autos, home furnishings, the postponable items, or services, travel, entertainment. It opens income up, lets your dollar of earnings go further, and that provided the support for consumer-led growth. Secondly, it allowed the Fed to move to the sidelines recently, back in the summer of this year. But even before that, interest rates were moving lower. That took some of the pressure off housing, which really suffered through much of 2022 and into early 2023. And it just simply provided a cushioning for the economy. Any credit-sensitive sector of the economy began to see some relief from that. We're seeing a carryover of that as we move through 2024. In fact, the economy finished 2023 in very good shape. Growth was well above average, and a lot of that momentum has carried into, and again, this is the economy as a whole. It varies industry by industry, but the economy has continued to grow at an above average rate right into early 2024. We do think that things will begin to wind down a bit, pent-up demand slowing a bit, inflation not dropping quite the way it did in late 2022 and through much of 2023. And we think the economy will begin to lose momentum. The combination of that and the fact that inflation is already below the Fed's target, if you look at the rate over the last 3 or 6 months, year over year, inflation is still over 3%. But if you look at the annualized rate over 3 months, over 6 months, regardless of how you want to measure it, whether it's the CPI, the Consumer Price Index, or the so-called PCE deflator, Personal Consumption Expenditures deflator, which is the favored measure of inflation by the Federal Reserve, those rates are currently running over that shorter period below 2%. And that's why the market has been anticipating the Fed cutting interest rates sooner than later. The expectation was March. By the markets. We saw interest rates come down accordingly. The Federal Reserve pushed back, as Mike said. They want more time. Wage inflation is still running at a pretty high rate. This low rate of inflation that we're seeing is a fairly recent phenomenon. The longer-term year-over-year inflation rate still still above its target rate. So they want to wait several more months. Our guess is, and it's only a guess, the way the trends are moving, we expect to see the Federal Reserve cutting interest rates beginning in June, May or June, more likely June. We're guessing 2 or 3 cuts before the Federal Reserve moves to the sidelines. That's a pretty short cycle. We could see it more extended than that. And we're making these guesses because they dovetail with investment strategy. There is a maxim on forecasting what the Fed's going to do, or any forecasting. Give them dates and give them numbers, but never give them dates and numbers together. Unfortunately, with the Federal Reserve, we know when they meet. We know what time they make the announcement. We have the meeting dates. So I think it's something like June 10th or June 11th when they make their announcement following the June FOMC meeting at 11 o'clock Pacific time. Check your dial, check your radio. They'll be making that announcement. We're guessing that'll be the first cut they make in this interest cycle. What does all that mean for investment strategy? Well, over the past couple of years, as we've gone through COVID and the recovery that's followed, a very uncertain economic environment, we focused on what we would call more of a defensive strategy. Our focus has been on the United States, for starters. And when I say focus, I don't mean to the exclusion of any other investment. We always advocate, and this is simple blocking and tackling an investment, make sure you're diversified between stocks and bonds, within stocks, the U.S. market, overseas, different sectors of the economy. Mutual funds do carry out that objective for you. But if you're an active investor, you take pretty much the same strategy, much the same in the bond market. But we had been focusing on the U.S. economy, what we call overweighting, allocating more money to the U.S. market than we normally would. That has a lot to do with what we call U.S. exceptionalism. We've done far better than most other economies around the world. For a developed economy, the strongest. Our growth rate is even stronger than China's now. Mike made the point that China today isn't the China of 20 years ago. They're more mature. They have fundamental problems, the property market, state and local government debt that they're dealing with. Their growth rate has really wound down. They're really struggling at the moment. Ours has been above average. I mean, the difference between our performance and those overseas, if anything, has widened over the past year. And we've been focused on the U.S. market. Within the U.S. market, we think liquidity, that is the ability to get in and out of a stock or a sector of the market, is very important. quality, financial quality, earnings resilience, stability, return on equity, low debt levels, low level of leverage. All these things are critical. And for the most part, and I'll get into that in a moment, sensitivity to the economy's ups and downs. We think that in a defensive strategy, you want to be low-keying that. You want a stock that doesn't tend to move up and down with the rest of the economy. What areas of the market do best in that kind of environment? Large cap stocks, very liquid, easy to trade them, move in and out. The high quality stocks, healthcare, for example, high return on equity, leverage is acceptable, have a great tailwind, demographics. They're not that sensitive to the economic cycle. They are sensitive to an aging population and a growing demand for healthcare. Small caps, on the other hand, good stock when good sector of the market when the economy begins to recover, but in uncertain times, they're the tail that tends to get wagged by the dog. In terms of sectors of the market, as I said, healthcare is one of the favorite sectors at the moment. Typically, we would also look at defensive stocks, those stocks that are resilient, whose revenue, earnings are fairly stable through the ups and downs of the economy. Things like consumer staples, these are the essential items, like food, small ticket items, soft goods. They don't tend to fluctuate as much, by and large, with the ups and downs in the economy. Utilities tend to be more stable as well. In this environment, though, we are continuing to focus on two of the more economically sensitive sectors of the market, materials and industrials. It has less to do with the economy than more with the long-term fundamentals out there. These areas of the market are not all that highly valued. Return on equity, fairly strong. The prospects, the longer-term prospects for these sectors, we think are reasonably good. In the materials sector, which Mike could speak to far better than me in the agricultural sector, but generally speaking, particularly for industrial materials, the materials sector, industrial metals and the like, we're going through what we call a super cycle. We go through these over extended periods of time. The super cycle simply means that there was underinvestment years ago. We didn't build up the capacity. So as the economy recovers, demand bumps up against that capacity pretty quickly. The market anticipates that, keeps those prices and revenues of companies reasonably strong. And with the kind of economic environment that we're looking at, we think that that will hold up reasonably well. Industrials, capital equipment manufacturers, defense, transportation, we think that will hold up as well, partly because of government stimulus out there, the spending that's being pumped into these areas, partly because defense, we think, has the opportunities out there down the road as well. And their financials, we think, are in reasonably good shape. Normally, it's a late cycle sector of the market where they do tend to get hit with a delay as the economy goes through a slowdown. But given the strengths out there, we think they will have the resilience going forward. Now, as we look through the latter part of 2024 and into 2025, we are looking for a recovery. With the Federal Reserve cutting interest rates, we think that will provide an underpinning to the interest-sensitive sectors of the economy. We're already seeing housing beginning to stir after it went through a difficult 12 to 18 months in late 2022 and through much of 2023. As the Fed lowers those interest rates, financial conditions ease up, we expect to see a recovery, not a powerful one. Typically, the deeper the recession, the stronger the recovery in the economy. And the reason for that is deep recessions bring with it a certain amount of what we call cleansing. You get financial conditions being rebuilt. People cut back on spending. Businesses cut back on spending. They reduce their debt. They reduce their leverage. Just a general rebuilding of finances. Credit quality begins to improve. Pent-up demand by deferring spending means that when conditions improve, there's a certain amount of catch-up out there as well. Businesses in a deep recession tend to liquidate inventories. As demand turns the corner, they rapidly rebuild. We're not going to get that kind of slowdown this time around, we don't think. It's going to be a fairly even, what we call a saucer-shaped economic cycle. Very gradual on the way down, very gradual on the way up. Gradual on the way up, in part because we don't see the kind of cleansing that we normally see. Debt will be fairly high. We're not going to get a lot of pent-up demand. Businesses have realigned inventories with sales, but we don't see a very aggressive liquidation, and that will keep things gradual going forward. However, the improvement out there, we think, will be enough that we're getting prepared to recommend a shift toward a more risk-oriented strategy in the equity market, which means tilting a little bit more toward what we call consumer discretionary industries. These are the big ticket items that do benefit to some extent from the revival of the economy. Technology, which we've been more neutral on of late, more because of valuations, less because of inherent weaknesses in the sector, we will be prepared to rotate toward as well. So some adjustments on the way. Much the same in the bond market. The focus is on quality. The focus is on treasuries. Treasury securities tend to do better when the economy is winding down. The corporate sector tends to get a bit riskier, even the higher grade, the higher quality corporates in the market. So we tend to shy away from that a bit. On top of that, yield premiums, the added yield that you get on corporate securities, whether it's investment grade or high yield, extraordinarily narrow right now from just a risk-reward standpoint. Given the uncertainties in the economy over the next several months, we think, we're just not getting paid to take on that added risk. All the more reason, we think, to focus on treasuries and munis. We think the yields are attractive there within the muni market. For those of you who follow it closely, we're beginning to tilt toward general obligation securities, moving away from essential service directed revenue bonds, partly because of the relative valuation. GOs, general obligation securities, are beginning to look a bit more attractive. As the economy recovers, we're prepared to move away from treasuries a bit more to the high-grade corporate securities. One other aspect to bond investing is what maturities do you put securities in? There had been a big move toward money market securities, money market investments, very short term when the Fed was raising interest rates. We still find that attractive, but with the Federal Reserve cutting rates, those short-term investments, the yield on those investments will come down, and you'll begin to notice it very quickly because given their short maturity, there's a regular rollover there. The area of the market that we think will be most attractive will be the intermediate securities in the 2 to 7 year maturity area. Why? That area is most sensitive to what the market thinks the Fed will be doing. And clearly the market is anticipating rate cuts there. And as the Fed makes those rate cuts, we think price appreciation will be most noticeable, already should be. The returns on that portion of the curve, we think, those maturities will be most attractive. Risks in the market. Comments on the economy, investments wouldn't be complete without the risks. Risks are a euphemism for excuses we have after our forecast goes wrong, and there's certainly no shortage of those. We're in an election year. Typically, elections don't have an enduring effect on the market, but with the polarization out there and the risk of still more swings, and those swings in policy have become greater and greater over the past couple of decades, it has had a more noticeable effect and a more enduring effect on market performance. One area, of course, is fiscal. There was the question about debt, and I think Mike answered it very well. Debt is over 100% of GDP, our ability to produce revenue as an economy to service that debt. We haven't seen that level since World War II, and that was very short-lived. We were issuing war bonds back in the 40s, and they were quickly redeemed afterward, and the debt came down. We were able to get away with these high debt levels when interest rates were low. As interest rates moved up, interest expense of the government began to climb. Interest expense was as low as about 8 or 9% of total government revenues, and this is the most uncontrollable spending item. You can mandate cuts in spending, but you can't mandate cuts in paying investors back for these securities in which they invested. 8 or 9% when those interest rates were down to 1, 2, maybe 3%, depending on the maturity of the investment. Now those rates are 2-3 percentage points higher. Interest expense is now up to 17% of government revenues. Historically, when that level, interest payments as a share of revenues, moved above 15%, we've seen the government move to try to contain the deficit. Why? Because the so-called bond market vigilantes, those investors that vote with their feet, opted not to invest in Treasury securities, or at least pull back a bit, moving into other areas of the market, or as in the 1970s, late 70s, when confidence in U.S. economic policy was eroded, they simply moved overseas. They moved into Swiss francs, gold, German marks before the advent of the euro. So there is an effect. We haven't seen it yet, but the risks grow as those revenues rise. The other areas of the market where we've seen that, the effect of higher interest rates, housing, I mentioned, that rolled over back in 2022, early 2023, and the stock market in general. When rates move up, valuations tend to go down. Why? Because when rates are moving up, bond prices are moving down. Mike told you about the relationship there. Bonds are becoming cheaper. And so investors tend to move out of stocks into bonds. That lowers the price. A price earnings multiple, how much investors are willing to pay for a dollar of earnings, currently over 20 times earnings at the moment for the S&P 500. I might add that that's a little distorted. It's focused on those so-called Magnificent Seven tech stocks. Valuations there are extreme. When you take that away, valuations in the market are not that wildly out of line. But in any event, when rates are moving up, as they have at times, we see money moving out of the market and stock prices suffer. I can remember back in the late 70s, early 80s, when interest rates were in double digits. Price earnings multiples, which, as I said, over 20 times earnings now, mid-single digits for PEs were pretty typical. So there is that relationship, and we can expect to see some sensitivity there. Having said that, if and when rates do begin to rise, if they rise unexpectedly early, for example, we don't expect to see the systemic, the broad-based, economy-wide impact that we saw, say, during the global financial crisis back in 2008. Why? For one thing, in this environment at least, we expect to see interest rates moving lower, not higher. That takes a lot of pressure off the economy. In fact, during the period of declining interest rates that we've seen over the past several months, financial stress has been coming down. Secondly, we're starting from a point where interest expense is just simply not that high relative to income, relative to revenue. We have a cushion. We have a good starting point. That interest expense had been brought down during that extended period of low interest rates. So even if interest rates were to move up, we do have that cushion before they become a real problem for the private sector of the economy. And third, you look at some of the credit quality measures in the economy, and they are deteriorating. Delinquency rates on credit card loans are moving up. But overall, we're starting from such a low point. Low interest rates had allowed finances to improve to the point that we still have that cushion as well. One area in closing, one of the risks out there is in commercial real estate. Clearly, there's an imbalance in the market. It's a holdover from COVID. We still think that there's a long-term adjustment taking place. If you look at some of the key areas of the market, I mean, vacancy rates are up around 30%. I know in San Francisco, for example, extraordinarily high. We've seen what we call price discovery over the last several months. In other words, transactions are just beginning to take place, and as expected, we've seen a steep decline in valuations. A couple of visible properties in LA and a couple of the other cities, particularly in LA, the price paid for an office tower in downtown Los Angeles down 40% from its price earlier on. We have a large amount of debt coming due, something like 1.2 trillion in property loans that have to be rolled over between now and 2027. It does look very ominous, but you really have to keep it in perspective. We fully agree that there will be disturbances out there. Regional banks have been the most visible, kind of the poster child for the problems that we've seen. We had problems a year ago. More recently, we've had a problem with a New York bank. just highlighting the fact that there will be an adjustment out there, but we think you really have to keep it in perspective. For one thing, office buildings, which are the center of the concern about commercial real estate, are about 20% of the total. There are other areas that are under some stress, but nothing like office towers. That's a large share, but it's not an overwhelming share like we had with the housing market some 15 years ago. Secondly, it's still a very segmented market. The big problems are along the two coasts, here in California, in New York, and within that, if you look at different quality properties, the vacancy rates, the fundamentals really vary. In San Francisco, for example, I'm a little dated here, but I think as of last fall, the vacancy rate for Class B buildings, for example, was up over 30%, about 35%. The vacancy rates for the Class A properties was down around 10%. Now, those higher quality properties are beginning to see the strain, but the point is that there still is some segmentation in the market. And finally, the transmission mechanism for a problem in commercial real estate is through the banking industry. And as I said, regional banks have been most exposed. But regional banks, and they're most exposed partly because they're less diversified than the larger banks. And in fact, they actually hold a dollar amount of those commercial real estate loans are greater than the dollar amount in the larger banks as well. But if you look at the share of small and regional banks in the total asset base for the commercial banking industry in the U.S., they're about 43%. It's not overwhelming, it's not small, but 57% of the assets, bank assets, are held by banks with assets of $250 billion or more. These are large, diversified banks that not only have a smaller share and dollar amount of commercial real estate loans, but are simply more diversified with more financing sources to keep them going. I don't mean to belittle the problem, but I just think it's a bit more containable. And finally, in the banking industry as a whole, their share of financial assets has been coming down steadily over the last several decades. As recently as the early 1990s, banks held about 30% of the assets in the financial sector. Today, that share is a little more than 17%. Now, they have a bigger ripple effect on the financial markets. They do finance other parts of the financial market. But the point is, it's not overwhelming. It's not as pervasive and systemic as it was, say, 15 years ago. And for that reason, we do expect to see disturbances out there, and they will ripple through the financial markets, stocks and bonds. But we don't expect to see them have that systemic effect taking the economy with them. The longer-term outlook, we think, continues to look pretty good. Inflation, we think, will be moving up a little bit, but nothing like what we saw about 2 or 3 years ago, or for that matter, the template back in the 1970s. We think that provides a good backdrop for financial assets. Commodities do look pretty attractive as well in this kind of environment because of the supply-demand fundamentals. But the investment environment, we think, will provide good opportunities with technology leading the way. In fact, technology playing a key role in that productivity that Mike spoke about a moment ago. Our favorable view on technology is based both on the digitalization of the economy, which has been taking place over the years, and more recently, artificial intelligence. We just think that is so pervasive, such a game changer, that will continue to serve the tech sector well going forward. And incidentally, the San Francisco office market, AI and artificial intelligence, San Francisco is on the leading edge of that, and we are beginning to see some ripple effect of that change on the market there as well. I'm out of breath. I'll pause here. Happy to answer any questions. Let me ask Mike to come back up, see if you have any questions of him as well, and we'll see if we can answer them.
Yes.
Well, as far as inflation goes, we still think the direction is lower for now. Partly because we think the economy will be losing a little momentum, partly because things like housing. Rents are about 30% of the consumer price index. And we had a big bulge in construction right through early last year. That's just beginning to come on the market, and we've seen rental inflation moving gradually lower. So even with a pickup in the economy later in the year, we think we'll see rental inflation continuing to create a headwind. We're looking for wage inflation to come down a little bit. Energy will be coming up, but food inflation will be fairly subdued. So we do look for year-over-year inflation dropping a little bit further, just below 3%, and that provides the backdrop for the Federal Reserve to cut interest rates. As we move into 2024 and into late 2024 and into 2025, typically inflation continues to move a bit lower. We think it'll be a little more grudging this time around, but we think inflation will stay down low enough for the Fed to stay on the sidelines for a time before moving back in. As the economy recovers through 2025, and this is really throwing a dart at this point, but we do see a gradual recovery continuing, you will start to see wage inflation level out, perhaps even move up. We have a fundamental tightening in the labor market simply because the workforce is aging. More people moving out than are moving in, or at least the gap between the two narrowing so that labor force growth slows. That's the supply of labor. Wage inflation steadying, perhaps moving up a bit, and just the excess capacity that might have been created this year being eliminated, inflation moving up. We could see the Federal Reserve begin raising interest rates, and this is really throwing a dart, but perhaps by late 2025. But it'll take a gradual rise in inflation, and the Fed, having been burned about 2 years ago by waiting as inflation spiked higher, might be a little bit more inclined to raise those interest rates. Keep in mind, too, Mike made the point about that other arm of monetary policy, quantitative tightening that we've seen where the Federal Reserve actually sells securities, tries to reduce its own balance sheet, its holding of securities, sucking up money from the financial markets. That was a tightening that we saw. We expect to see them relax that. Buying up securities, we think, will taper off and will end by the end of 2024. So that will be another leg of easing in monetary policy for a time. Yes?
We're obviously at 350,000 jobs. We're reading that most of the jobs being created are government, or I'm going to use the term medical broadly, but basically that's going to be government. What's that going to do to the economy?
Yeah, well, I mean, that's a good point. I think it's a little overstated. We are continuing to grow. We're seeing growth in the private sector. So there is demand for labor in those areas. But your point's well taken. If you look real hard, a lot of the growth is in healthcare. That's a growth industry to begin with, as I mentioned, simply because of demographics. As we age, our demand for healthcare services goes up a bit. And we also fell behind during COVID. A lot of healthcare workers moved to the sidelines. So a lot of the strength's there. Government has tapered off a little bit. Other industries, services industries, have continued to hold up well. Travel, entertainment, Mike made the point about dining out, and that's very labor intensive. And that's kept the pressure on hiring, what we call leisure and hospitality. That's the travel and entertainment, dining out, and that's held up quite well too. But I think you make a good point. If you look at the aggregate of employment growth, the economically sensitive industries, that component in the job market, that growth has begun to taper off, which to us is one of several signs that the economy is losing a little bit of momentum from above average growth going forward. And for that reason, we look for the labor market to soften up a bit and allow wages to come down temporarily. But wage inflation that we took for granted as being suppressed over the last 5-7 years, labor's bargaining power was very weak. And we think that's changing, partly because of the demographics, looking through the ups and downs of the economy, more people retiring, a lot of us baby boomers, moving to the sidelines. I'll give you an example. Labor force participation. The labor force participation rate, that's simply the number of people employed or actively looking for a job as a share of the workforce in that particular age group. Prime age working population, 25 to 54 years old, that participation rate is 83, 84%. For people over 55, it's 35%. So you get an idea of just what effect retiring has on the labor force. And as more and more people reach that 55 and over age, it's going to slow labor force growth, which means that demand is going to be bumping up against that supply, and we think that will keep more pressure on wages, independent of where we are in the economic cycle. And that's why the key to the longer term outlook, again, getting back to the point Mike made, is productivity, how much you're getting out of each worker. And if Romania has a lot of workers, but they're not producing much, that's not the answer. You've got to look for the areas where we've produced, but try to get more out of each worker. And you typically do that through capital investment, tech investment, and we have the opportunity with digitalization that we've already been seeing and artificial intelligence, which we think will offset that. The rubber meets the road with unit labor costs, not wages. Wages are what you pay a worker. Unit labor costs are what you pay the worker, adjusted for how much you're getting out of the worker, and that really will be the key.
We hear a lot about corporate defaults, and they're up sharply. What does that mean in terms of, the medium term effect? Because you don't really hear the follow-up, as to why, to the interest rates, and what does it mean overall?
Question had to do with corporate defaults. What does it mean for the economy? We are seeing the corporate default rate moving up, but keeping it in perspective, much like some of these other credit quality measures for households and businesses, they're moving up from a very low base. Corporations had an extended period not only of low interest rates, but they took the opportunity, much like to some extent the government, to lock in that debt at low interest rates, moving into longer term debt. So there will be a refinancing wall. It is approaching in commercial real estate. And the problem, incidentally, in commercial real estate is that a lot of the financing is variable rate. So when those rates go up, the property owner feels the effect of that straight away. The saving grace for commercial real estate, why it really hasn't hit the fan so far, is that the amount of debt due has been fairly low over the last couple of years. It will be rising, as I said, $1.2 trillion over the next few years. But away from that, the financing burden, if you look at interest payments as a share of revenues for the corporate sector as a whole, still extraordinarily low by historic standards. Now, Mike's analogy about that 42-degree average for North Dakota also holds with businesses. I mean, we have high yield, low quality stretched finances corporations that are more vulnerable, and we are seeing those defaults as a result of that. And when you marry that with disruptions in an industry, say the airline industry doing very well, if we were to suddenly see that dropping off, and we have at times, that can trigger defaults even in the high grade area to a much lesser extent. But the point about defaults in the economy, still low enough now that it's not going to pose an immediate threat. But if the economy slows enough, and if interest rates stay elevated, the combination of those two things begin to bring default rates back up to an area that's more of a red zone, a yellow zone, and that begins to have more of an effect. You see the pullback in spending, you see the massive layoffs, and we've seen the visible layoffs in a couple of industries, large trucking company going under. But it's really more sporadic at this point. The overall backdrop, we think, still is supportive to the economy and economic growth. Yes, Scott.
Dr. Swanson, last year, one of your themes, with the capital costs increasing, was where do people invest? And it's a spectrum of scale to scope. I think Gary kind of touched on that in your last question there. But can you talk about what you see in business folks across the country, where people are investing capital expenditure expenses?
Sure. So, thank you, Gary. So Scott and I often talk with customers about where do they want to put their next investment, right? Do they want to do more of what you're currently doing, that'd be scale, or do you want to do something different because you say, hey, the returns are so much better. I have a supplier, I look at his returns, I just want to do what he does and make more money there. So that would be scope. You'd move someplace else. And so what we've seen is, as interest rates have changed, it has an impact on that mentality. You always buy companies based about what's the current interest rate. But going to your question, one of the things I said this yesterday is, if you make big investments in productivity, capital investments for more scale, it leads to market share wars. Because typically your ability to produce grows much faster than the organic market's growing. And so you just literally lock yourself into this market share battle where you need to go get your competition's market share. And it's going to be interesting because we're seeing a lot of investments in artificial intelligence, in productivity, in capital improvement, robotics, things like that. And it almost guarantees that you get better scale, but you also almost guarantee yourself another price war as you go after your competition's market share. And so interest rates are kind of one of these interesting thermostats. We have thermostat on the wall. What it kicks on and kicks off is competition. And so it's a great question. Once again, it's a question that best discussed over your conference table at your boardroom, as we talk about the numbers that we're actually seeing in that industry and what do you think your market share potential would be around that scale or scope. The grass is always greener over someone else's septic tank. That's just the old statement, right? We just don't see the problems that they have in their business. You're like, oh man, they have a great business. And they would tell you pretty quick, it's like, you're not seeing what I'm seeing. But scale and scope are always, they're the only two questions you have. If you're going to grow, if you're one of those top lines that we saw for returns, you want to grow. You either got to take somebody else's share or you have to go into a different market. That's a great question. Thank you. Yes?
What do you see with the housing interest rates going forward this year?
So the question is, what are we seeing with the housing interest rates going forward? It's really tied to that 10-year Treasury rate that we were talking about earlier, because there's a spread. So if you're going to make a mortgage-backed security loan, you look at, well, what if I just lent it to the government and didn't have to hassle with a homeowner? So I want to get enough of a premium over the 10-year Treasury for the hassle that's going to come into making the loan to the homeowner. And so there's two parts to that. We expect the 10-year Treasuries to kind of keep declining because as the interest rate comes down, so do the Treasury yields come down. And if that comes down, then the mortgage-backed securities will come down with them. I mean, we spiked at the end of last year. At one point, we had 8% on 30-year fixed-rate mortgages. If you look at the current price of housing, it's really hard to finance it at 8% because it was priced to move at 3.5%. And so even if the 10-year Treasuries come down, the mortgage-backed securities will follow them down, it's still going to be a very high mortgage rate for the current price of housing. So here's my expectation. It's going to be cheaper to finance it, margin, maybe 50 basis points, 100 basis points. But people are coming back to their senses saying that's a really big monthly payment. Most people do not buy their house. They rent it from the bank, right? So they're looking at their monthly payment. And right now, with the price of housing where it is and the interest rate where it is, they're like, that's a huge monthly payment. So am I better off renting something as an alternative, or do I buy it today and hope to refinance it in 2 or 3 years when I think mortgage rates will back down 250 basis points? A lot of people are willing to make that. But the housing market, which has really been above average, boiling way too hot, is kind of coming back off that insane boiling rate that it was going on.
Thanks, Mike. Just one other wrinkle. What's unusual about this housing market, and if you're in the industry, I'm sure you know, is it isn't only demand, it's the supply side. We've had such a spike in mortgage rates from where they were just a few years ago when they were down around 2-3%, that the trade-up market has almost evaporated. And there are reasons why people trade up, forming family, expanding families, perhaps downsizing, retirees these days, upside, whatever it is, people haven't moved to the extent they have to finance a mortgage. Why go from a house that has carrying a 2 to 3% mortgage rate to a place that has a mortgage rate of 6.5%, 7%? Now, there are people that have to trade up. So even a modest move down in mortgage rates, as we've seen so far, has begun to loosen up the market just a bit. And as mortgage rates, as Mike mentioned, we do see some additional downside. They may move up a little bit. The 10-year Treasury, that's the anchor, did move down late last year, early this year. It may be moving back up temporarily, but net, by the end of the year, we do expect to see a further decline, modest, in that 10-year Treasury and the fixed-rate mortgage that's tied to it. And we think that will have the effect of softening up supply a bit. We're already seeing the inventory of unsold homes relative to sales, which had been down below 3 months equivalent of sales. The long-term norm is 5.5, 6. We've started to see that inventory rise a little bit. All that to say that keep your eye on mortgage rates, but also keep your eye on home prices. As supply loosens up a bit, we're not looking for a collapse in prices, but that very rapid rise in prices that we had seen may level off a bit, even with mortgage rates coming down, because of that driver that we had that really froze up supply a bit. Unusual situation in the market this time around, again related to COVID and the spike in inflation and interest rates.
I think we're going to hand it back over to Rich right now for the final word. Thank you very much.
Thank you.
Gary, that was wonderful, and we know you've traveled a long distance to be here. I know I came away with a number of valuable insights, as I know the rest of the group here did today, too. And thank you all for being here today. It's been wonderful to spend some time. Moreover, thank you for your business. We really appreciate it, and it's something that as I'm engaged in the market and the team is, please let us know how we can help you. If there's anything we can do, please never hesitate to call, and please travel safely to your next destination. Thank you very much.